Okay, hello everyone, and welcome to today's Employee Ownership Explained webinar, Making Employee Ownership Work. And many thanks for joining us today. For those who don't know me, my name is Angela, and I look after the marketing and communications for Cooperative Development Scotland. Just before we get started, I'm going to take a few minutes to talk you through details of how today's session will work. I will be your host, and Carole Leslie from Ownership Associates will be our speaker. In addition, we are delighted to have a panel of employee-owned business people with us who have experienced the process from the other side of the table. Bill Grossart from Grossart Associates, Innes Chalmers from Scottish Gallery, and Sheila and Fraser Dunphy, former owners of Finesse Control Systems. As an attendee, you should be muted with no live video. You will all have caught sight of the agenda. However, as a reminder, today's webinar will begin with a short overview from me and a poll. Carole will deliver her presentation, and that will be followed by a Q&A session. Please feel free to ask questions throughout the session using the Q&A functionality. These will be addressed during the Q&A session. You will also have the opportunity to raise your hand and ask a live question during the Q&A. After the Q&A, there will be a final poll and the session will close. When we close the webinar, a short evaluation should appear. We would be grateful if you could complete this. If this isn't possible, a summary of the session and recording will be sent to you along with the evaluation. So let's move on to my overview. So who's CDS and why employee ownership? In case you're not aware, Cooperative Development Scotland is a specialist unit within Scottish Enterprise. Our role is to raise awareness of and increase the number of businesses considering employee ownership. We offer our clients an ownership succession review and employee ownership feasibility study. So why employee ownership? There's been a real surge in interest in employee ownership since the 2014 Finance Act introduced a new model for employee ownership, the Employee Ownership Trust. However, more recently, we're seeing three main changes for the increased interest in EOTs. Owners looking to retire, a decrease in the entrepreneur's relief, and a potential change to capital gains tax. So what does the employee ownership sector look like? According to the White Rose Centre for Employee Ownership Survey 2020, which took place in June, there are around 470 employee-owned businesses in the UK, with Scotland second only to London in the growth of employee-owned businesses. According to the CDS database, there are over 120 employee-owned businesses operating in Scotland with a combined turnover of around 900 million and around 7,500 employee owners. With regards to transactions, there have been at least 10 transitions to at least 10 sales to an EOT this year alone that we're aware of. The Scottish Government has an aspiration for the sector to have 500 employee-owned businesses by 2030 and has set up a public-private partnership industry leadership group called Scotland for EO, which CDS is part of. Finally, here are some examples of employee-owned businesses. Before I hand you over to Carole to deliver a presentation, we would like to conduct a short poll of 3 questions to gauge the knowledge in the audience. We'd be grateful if you could respond to these. Here we go. Again, apologies to those who've attended previous webinars. You'll probably already have seen these questions. However, hopefully your responses may have changed. There we go, a bit of a mixed bag. There we go, next question. There we go, interesting results. Is that our last question, Carole?
No, another one. We've got fewer experts this time. That's a bit of a worry if we get any difficult questions. Final question.
There we go. Hopefully the answers to these questions will probably be higher at the end of the session. Thank you very much for the responses. Now I'm going to hand over to Carole Leslie. For those who don't know Carole Leslie has been active in the field of employee ownership for 16 years, having supported over 60 companies in their move to an employee-owned structure. She's been a specialist advisor to Cooperative Development Scotland since 2012, advising business owners on their succession options. She's worked with companies with turnover from over 250 million to smaller businesses with a 1 million turnover, and across a range of sectors. Carole is a non-executive director with employee-owned Mediascape and is also an independent trustee with a number of employee ownership trusts. We go over to you, Carole.
Okay, thank you, Angela, and welcome everybody. Delighted to have such a high number of attendees for this webinar, which really does reinforce what you were saying, Angela, about the interest that we're getting now. So these webinars were designed largely for continual professional development for advisors, so lawyers, accountants, and banks. But it's great to see that it's really widened, and we've got quite a diverse audience today. So what I'm going to talk about is the employee ownership trust transaction process. And what I've got to say from the beginning is this is very much drawn from my own experience working as an advisor in this field for, that's 50 years I've actually worked as an advisor, 15, not 50. And I'm not saying this is the only way to do it, and I'm not even saying this is the best way to do it, but this is how I tend to approach it, and it does tend to work for me. I've worked on 60+ transactions, as Angela said. And what I've done for the purposes of a presentation is I've tried to distill this down to 5 steps. But in reality, there really is lots and lots of pieces to this jigsaw. So before we actually get on that first step, a question that sometimes comes up is, how do business owners arrive at the steps in the first place? And by far, most of the companies that I work with tend to be as a result of referral from companies I've already helped through the process. And I've got to say hats off to Bill Grossart, who's very good at referring his customers and suppliers to me. So it is that word of mouth, I think, that really spreads the knowledge. There's also, I'm getting an increasing number of referrals from advisors, particularly accountants. And you also get quite a bit of interest whenever there's a completion and there's public publicity around about the completion. And then of course CDS do a fantastic job in spreading the word inside Scottish Enterprise, and through that accounts network, as well as some of their own publicity, that's a really good pool of gathering companies that might be interested in doing this. So let's start with the first part, the first step, and this is, I'd say, probably the most important one. And if we invest a lot of time in this first initial conversation, then you're more likely to get an outcome that's going to fit with what the owner's trying to achieve and fit with the needs of the business and the other stakeholders going forward. So the first question I would ask is, what is the seller trying to achieve from this? And first is probably a bit of a reality check on what their expectations might be from what employee ownership will actually do and what it will mean for them and for the business. Their drivers are important, because it's what their drivers are to follow this path that will shape the deal largely. So if this is about legacy, or if it's about protecting the employment of the loyal employee group, as if it's rewarding employees for their commitment over the years, if it's about keeping business local and independent, or if it's just about realising value, then that motivation is really going to drive what happens next. And Another key question is, how long does the owner see themselves remaining with the business? When business owners take this path, they tend, one of the attractions is it allows them to phase their exit from the company. So they don't often see this as you would maybe in a trade sale or a management buyout where the owner leaves immediately. Usually they have got a plan to gradually wind down, and it's that winding down that would determine how we form the other parts of the deal. So it's critical we get all that on the table to start with. But of course, it's not set in stone. People can change their minds, and often do, as we go through the process. So I'd say that's the first step. The first stage is really getting all that on the table, and then we take it from there to look at what's going to happen next. The next key question is employee ownership feasible? It's there's a bit of, there used to be, it's not actually as bad now, but there used to be a bit of a myth that employee ownership was a kind of last resort or a rescue, and it's definitely not. It's very, very far from that. This is a model for businesses that are successful. It's a model for businesses that have got a future out there. So it's got to be successful. It's got to be able to generate cash. It's got to have some forecast of profitability. And because these deals tend to be vendor financed to a large extent, then it's got to be able to generate sufficient cash to cover the sale price. Other questions about the position in the market: is there longevity in the business? This is not something for the short term. It's very much a long-term model. So we're looking at how secure is the future. It's also probably worth throwing in at this point that this is not a cheap thing to do. It's probably not nearly as expensive as, say, the costs of a trade sale or any other kind of transaction, but it's an expensive thing to do. So I think companies have to have a certain scale before it's worthwhile thinking about. So we know why the owner's trying to do this. We've assessed the company as being feasible, and they've decided they want to go ahead. So the first step then, I would say, is you build the project team roundabout, and that is about choosing the advisors that you want to work with. So how do you choose? You can use your incumbent advisor. So if you already have a company lawyer, company accountant, and so on. What a lot of companies tend to do, though, they tend to like to use people who have done it before because they've got that expertise, and they have the EOT is not a particularly complicated bit of legislation, but it is quite specialist. And as you said, Angela, it's 2014 it came out, so it's still relatively new. So the incumbent advisor may not have the experience to be able to deal with it, and may be quite happy if the company uses someone who's got more expert in the area. But more than that expertise, I think it's important that the business owner, they select a partner that they can work with. They're probably only going to do this once, so they want to work with someone that they can trust will look after not only their best interests, but will look after the outcome on behalf of all the stakeholders, so the employees, the customers, suppliers, community, and so on. These transactions tend to be quite unusual. Certainly over the last 10 years, it's much more usual now that you only actually have one law firm working through the process, and that firm would usually represent the trust, sometimes represent the company, but very, very rarely are they representing the seller. The seller's always advised to get their own advice, but in truth, they very rarely do. And I believe they rarely do that because they've been there every step of the way, they've been part of every conversation, and they're usually quite comfortable and confident that what they've got is the best result for them. So they're always advised to get an advisor, but usually we just have the one law firm, and of course that manages to contain the costs. Timescales, it's an interesting one. Timescales have got shorter, I would say, over the last few years. We used to do these over, I would say 12 months. And if you look at Aquascot and Alness, they took 8 years to transition from owner management to full employee ownership. I would say now we're probably looking at 3 to 4 months. 3 to 4 months being your average time to get the project from your initial conversation, starting the process, to the actual completion of the transaction. That can be done in, can't be done in much less than that, but it's quite acceptable to take more. And it's not, what I would say is, again, a business owner is only going to do this once probably, so they should take as much time as they need to be able to do it. Leadership succession, now this is a bit of a thorny one, because if this is an exit plan, for the business owner, then the only way they can really exit if there's someone else there ready to take over the reins. So they really have to have some thought into who's that going to be? Is it going to be 1 or 2 or 3 or a trusted team of people? Is it going to be an internal or an external appointment? And that itself takes a bit of time. And as part of the exit plan for the owner, you have to look at how you're going to develop and coach people to get up to the level that they can take on the company. So that's sometimes one of the challenges. And then you've got the financial considerations as well. Quite a lot of owner managers won't be taking a market salary from the business. They tend to rely on dividends as part of their remuneration. And if they're going to put, for example, 100% of their shares in a trust, they'll no longer qualify for dividends. So we'll also have to have that conversation about how are we going to fix the salary and how are we going to taper that with them reducing their time in the business. So there's some considerations there. Also, it's not unusual, and it's actually more or less acceptable or accepted, that there will be family members in the business. That's probably not going to be appropriate if they're not doing what you would see as a job that contributes to the company. So how do we manage that? And then if there's any other benefits, like sometimes there might be holiday property that's kept, that's actually financed by the business but isn't really a business thing. Maybe there's a prestige car in there that's not really appropriate to go post-transaction. So getting all these and actually doing a wee bit of housekeeping and tidying all that up before we start. So that's initial conversations. And then getting onto the valuation. Now this, I would say, once we know where we're going, this is probably the first hurdle that we might fall at. And it's important to surface expectations. People can be a bit coy at saying how much they want, what's their expectation. And if they've already been down a road maybe with a trade sale, they might have some idea what a market value might be. There might also be some unrealistic expectations that might have to be challenged at some times. Sometimes you do have to dig a bit deeper to unearth what they're really looking for. Andrew Sloan, actually, at one of the previous webinars, made a good point about this should be part of overall financial planning for business owners, and I'm not sure that many of them do that. So as part of the feasibility that CDS would sometimes sponsor, we give an indicative value for the business. And usually when we've had our initial conversation, we're able to give some kind of a flavour of what that value might look like. But that is only indicative, and it's a very kind of maybe quick and dirty calculation that you might come up with. Before we can really go ahead, we need a formal valuation, and that would be undertaken by either the company's accountant or an independent accountant. And that is the one that would be submitted to HMRC as part of the tax clearance application. If that number is not acceptable to the seller, then the deal's off, it doesn't go ahead. But hopefully it is. As well as the actual figure being acceptable, we have to look at the company's future maintainable earnings to be able to calculate what that payback period might look like, because depending on someone's lifestyle and plans, 5 years might be acceptable, 10 years might not. So we have to get a workable payback period that it's not only satisfies the seller, it's also got to fit with the business without putting stress on the company's cash, because the company's got to keep going, the company's got to keep growing and flourishing during this time. One of the key areas here for the seller to be comfortable with is they've got to accept there's a risk here. They're relying on the company being successful for a long time to be able to generate the cash to cover the price of the business. And yes, there are certain protections that can be built in, but at the end of the day, they're relying on the company being able to pay them back. And this has been a very challenging year for a lot of companies in terms of cash. So there has been, with some companies, a bit of negotiation on reducing payments, extending the term and so on. So the owner has to go into this with their eyes open, that they have this risk. It's interesting about charging interest. It's actually quite acceptable for there to be interest levied on this, because it is effectively a loan from the company. Some sellers do, some sellers don't. One thing I would say, because I tend to stay involved with companies post-transaction for a long number of years, that I would say that interest has got to be reasonable. I think it's too easy to create resentment further down the line if that interest rate is seen as too high and unfair when you've got new leadership coming in. The other thing that's actually very usual to include is an anti-embarrassment clause. Like, very quickly, and there'll be people on here that can explain it far better than I can. An anti-embarrassment clause is just recognising that the sellers have had a big contribution to the value of the business, and if it was to sell quickly after the transaction, then they should, and there's an uplift in the price that they got, then they should get a slice of that. So you tend to have a percentage that tapers down over time, usually 5 years, sometimes a bit longer, but usually 5 years. And that's the anti-embarrassment clause, and it's perfectly normal for that to be there. One thing to bear in mind, though, that if there is going to be a sale relatively soon after the employee ownership transaction, it's very likely there will be a tax clawback of the capital gains tax relief. So you do have to be aware that it's there could be significant tax charges on any future sale. So then we start building the model, and one of the key questions here is what percentage of shares would we be selling to the trust? So as long as there's over 50% of the 50.1% of the shares going to trust, then that transaction qualifies for capital gains tax relief. So you're generally looking at between 50.1% and 100% of the shares going into the trust. Now, what you have to think about for the seller is that if they are looking to hold on to shares, how would they then look to exit that shareholding? Because a minority shareholding in a company that's majority controlled by an employee ownership trust is not an attractive proposition to an external buyer. So effectively, if the owners are wanting to hold on to a shareholding, then you have to, the most likely buyer would be the trust itself. The trust is going to be focused on paying off the initial consideration. So you're relying on the trust having the cash and the trustees having the will to buy that shareholding back at some point in the future. So we do tend to have quite an in-depth conversation around about what kind of percentage would they be looking to sell. Most companies go with 100%, and some look at 80%, with the seller retaining 10 to 20%, and that tends to be more of a, I'd say, emotional stake than looking for some kind of financial return on that. What I should say as well is you only get one bite of the cherry at the tax relief, so you don't get it on any future sales to the trust. It's only on that initial controlling interest. Then have to have a conversation around company governance. Most small companies, not even just small companies, medium companies, tend to have quite a relaxed approach to corporate governance, maybe not having formal board meetings and usually having one director. It's probably more appropriate when the company moves into employee ownership. It's got a more formal structure, more transparency, more accountability, clearer lines of control. So it would be usual to then think about, would you be appointing more directors to the board? Who would they be? And making sure that these individuals are very aware of the responsibilities of being a director. I feel I'm going to start a coughing fit, sorry. Initial conversations about the trust and trustees reveal quite a bit of nervousness around about the trust. And I think people maybe think the trust is going to be running the company, making decisions that affect the everyday, and that is not the trust role at all. The trust is there to make sure the company is run in the best interest of the beneficiaries. The trust is not there to run the company, they only run the trust. It is normal to have, because the trust, the beneficiaries of the trust are employees, it's usual to have employees as trustees. And that can sometimes make people a bit nervous. Well, what if they elect someone that's really bullshit? I would say, and I can't think of any exceptions to this, when you have elected employees, people tend to elect the right people. So it should not be a concern when you're looking at elected positions. But the trust and trustees, very, very important in an employee-owned company, because that's where you get the scrutiny and oversight. That's where you get the kind of checks and balances that any new leadership is sticking to the rules, working in the best interests, managing egos, just making sure that all the right things are done in the right way. So it's really important that people understand what the trust and the trustees' purpose is. In terms of the trustees, it's usual for the seller to have a position as a trustee, And then it's usual as well to have an independent trustee. And I think that's a very good addition, because that means that a trust does stay on topic with what they should be discussing. There's sometimes a kind of desire to appoint quite senior people as trustees rather than elected employees. If you're looking at the trust as being there for scrutiny, then if you have too much duplication between the board and the trust, then you really don't get that transparency and accountability. So really important discussion over who the trust and trustees will be. Quite a lot of companies, they'll have property as part of their assets, and there'll be a conversation round about how do we manage that property? Is it going to be part of the transaction, or is it going to be retained by the owner and then leased back? And then what are the terms of that lease? Because it's got to be fair to the company going forward, but it's also got to be fair and realistic for the seller as well. It used to be very common that we would have share schemes as part of the employee-owned model. And I would say for the first 10 years that I worked in this, your typical model was have a EBT and a share incentive plan. I very rarely do share incentive plans now. It's more usual to put in enterprise management incentives, EMIs. And if you are going to have a share scheme, either at the point of transaction or further down the line, it's important to kind of craft that into the documentation, so you're not having to go back and get the Articles of Association rewritten once you want to implement a share scheme. Another interesting aspect that is there any of the key drivers that the owner came out with in the first conversations that are very important to them, that we really want to kind of solidify in the deal? So, for example, it's not unusual for there to be some kind of commitment to the company remaining local. So the company must remain in Falkirk or Arbroath or Dundee or whatever, and that's actually part of the legal documentation. So it's very, very difficult for the company to go a different direction. Other ones is commitment to training, commitment to being leaders in the sector, and that can all be written in, and when it's written into the legal documentation, it becomes an obligation for the company's board to deliver and for the trustees to make sure that it is delivered. So it's worthwhile having that. What I would say about the kind of wishes though, you would not want that to be too restrictive on the company in the future. So, if the company was maybe in a small village and it was wanting to grow, it maybe made sense for it to move somewhere else. But again, the seller's got a lot of control how that looks. Funding. So usually, as I said, these deals tend to be vendor financed. And the seller has got to be quite comfortable with that. It's a trust that funds the deal. So the debt would sit with the trust. It doesn't appear in the company balance sheet. It sits with the trust. But of course, the trust isn't a trading business, so it's not generating any cash. It's relying on contributions from the company to fund the repayments to the vendors. What we are seeing is an increasing appetite from banks to support EOT transactions. And there's a number of banks actually, in fact, there's a few banks present today who really are doing their utmost to try and promote employee ownership, which is absolutely great to see. What I would say is that you then, if you're looking to get some bank funding in, you have to allow a little bit of extra time for the bank processes. But what companies that I've worked with, and in fact, Bill Grothart might be willing to talk about this, companies I work with, they have found that their actual account managers, relationship managers in the bank have been very supportive through that process. So that's really good. There's also a number of specialist lenders who specialise in lending for employee ownership transactions, and they tend to be much quicker in terms of process than the mainstream banks, but the interest rates do tend to be higher to reflect the higher risks that they see here. So there's lots of ways to achieve this, and it really depends on what's the seller's appetite and what's the kind of financial landscape of the company before you make any decisions on it. So funding, and what I would say is funding is much easier to procure now than it was just a few years ago. So that's great. Finally, my final step was the stakeholder communication. Obviously, the employee is very, very important. They're going to own the company. The key questions are, when do you tell them and what do you tell them? I used to think the earlier the better, But actually, over the years where I've seen deals sometimes go a wee bit awry and delayed, I feel now that you're probably better holding back with that employee communication until such times as you're actually very, very clear on what the model is going to look like and what the timescale is. Because if you go to a group of employees and be very, very vague, it can only raise concerns and people get worried about it. So I would say you go to employees when you're quite clear that it's actually going to happen, you've got an idea of when it's going to happen, and you know what the model is going to look like. When you say what, normally when you're doing your first initial employee communication, how it usually structure it is you have the seller given their story, their why they started looking at employee ownership, and then I usually come on and explain what it actually means. But I can tell you, the bit that I say probably nobody actually hears, because all people want to know is, have I still got a job? What will it mean for me? So what I do is you follow that up with lots of documentation and then follow-up meetings, workshops, offer one-to-ones, just so people are comfortable with it. It's tremendously good news for employees. There are no downsides, only upsides here. So it's important that your employees are all comfortable with it. My exception to telling employees at the end is you've got any really trusted employees, senior people, the ones you think are going to step into your shoes when you go, then you probably want to bring them into your conference a wee bit sooner so that they can probably have some say in what the outcome's going to look like, what the deal's going to be like. It's also important to inform your customers. I think there could be nothing worse for a customer who thinks they're really important to the business to read about this in the news or to find it on a company's house search. So I would advise making a special point of telling your key customers, probably, well, you can't do face-to-face these days, Zoom to Zoom or whatever, or having a letter that goes out, an email that goes out to them and just explaining what it means. It secures the future of the company, and now everybody's got a stake in that customer success. It's a very positive news for customers. Similarly with suppliers, one thing you have to watch with suppliers is if you've got a contract with them, there might be change of control, change of ownership clauses. So you're sometimes obliged to notify your suppliers of any changes in the ownership of the company. And finally, it's a fantastic PR opportunity. It really is. Companies report that the PR that they get on announcing a completion to employee ownership really reaps the benefits and does so for a long time. I was talking to Simon Poole of Gerba Camper Vans last week, and he was saying that they shout about their employee ownership every time they're in the news because it really just drives so many benefits for them. So all good news there. And that's just my contact details. What I think is, I always say the strongest argument for employee ownership is speaking to companies themselves. So what I've thought would do is bring in some companies who've already gone down this route. And feel free to ask them questions, and I will also have some...
That's great. Carole, do you want me to give a quick introduction to our panel?
Oh, yes, please. Yes, please.
Thanks for the presentation, Carole. Again, really just want to give a short introduction. We've got Bill Grossart, who transferred his engineering consultancy, Grossart Associates, to employee ownership last year, in a deal that was part vendor funded and part funded by Barclays Bank. We've got Innes Chalmers, who is Finance Director of Scottish Gallery, the iconic Edinburgh-based institution, which also became employee-owned last year. And finally, we've got Sheila and Fraser Dunphy, former owners of Finesse Control Systems, based in Arbroath, which became employed on the 1st of July this year during lockdown. So I'll hand over Carole to speak to the panelists and commence the Q&A.
Hey, Fraser, can you unmute?
No.
I'm not sure if you're able to.
You should be.
Hello, can you hear us?
Can you hear us?
Yes, I can hear you. Oh, sorry. So Sheila's with Fraser.
Yes, I am.
Right. Okay. I'm sorry. I was looking for your name on the list, Sheila, and I couldn't find you. And Bill, we can't see you, but we can hear you.
How do I fix that, Carole? So,
do you want me to stop my video, Carole? That might allow Bill on.
No, I don't think that should have anything to do with it.
Yeah, basically, if I can scroll along the top of the panel, I can see people. Although Bill, I don't know if you've got your video on, Bill.
So how do I put it on again, guys? Which I'm up at the top here. I've got.
Oh, Bill, I don't know. I'll tell you what. We'll just bear with hearing you and not seeing you.
Okay, that's fine.
I can tell everybody Bill's really handsome. So.
You mean I'll get my hair washed for nothing, Carol? This is terrible.
Sorry. Bill, can we start?
Hello.
Right, okay. Bill, can we start with you? Can I ask, you first of all chose another path. Why did you change your mind and follow the employee ownership route? Oh, Bill, you've muted yourself.
Right. Got me now, Carol?
Okay, yeah, you've got you now. Okay. So your first action really was to look at selling to a larger company, wasn't it?
Well, we received several unsolicited bids for the practice from basically, it was in all instances it was English consultants who were looking to expand into Scotland. I think they looked at our practice and seen that it was pretty rounded and it would be a good arrow to their bow. You know, we looked at them. They even went to the effect, we didn't know what the business was worth. So the bids were very varied and very onerous, and the caveats with regards to the sale were, we found it we were having to keep profits up and keep the staff incentivised. We just felt that it wasn't an easy thing to do. And it was over, just like the EOT is over we've got ours over, spread over 5 years. They were looking to spread out over 3 years. And it's just, it just goes, hello, can you see me now? We just felt that it wasn't the correct path, given and also we were concerned that the staff, which had been with us a long number of years, would have been, they were just buying the assets, basically, our clients, and not the overall business. To the extent that we went down the route of employing a marketing company to market us, and that they also introduced us to other buyers, potential buyers, but it was the same scenario in every instance. It was the caveats, and the buyout was structured for the buyer, basically, not the seller. And I think Carole knows the story that I was sitting reading the Mail on Sunday Sunday morning, and I seen this article on employee ownership trusts. Next day I was out in business, and I spoke to a chap who Carole and I was doing work for this lad. We were doing work for this client, and I said, "Do you know anybody who does employee ownership trusts?" And he put me in touch with Carole, and that started the ball rolling. And it was a long and winding road, as the Beatles said, but it's certainly worth it from our perspective, I think, as the sellers. And I think it's also been worth it for our staff, because they've now taken ducks to water to employee ownership, and they're running the business in a very well-governed way. And I think, I suppose I'm a bit surprised, maybe, which is maybe wrong, but I didn't know how it was going to work out. As Carole said in her spiel, you don't know how the transition is going to go, because we basically, John McDonald and I, who was the other director, the two of us own 50% of the shares each. We've stepped back basically and let them go on with it. I thought it might have been difficult, but to be honest, it hasn't really been. I mean, and that's down to the staff. It's not down to anything else. We're still involved. I'm still a director and a trustee, and I'm on the board of trustees. And I found the trustees as well. The employee elected directors been excellent, and the two trustees, they're really involved in the business. They're proactive, not reactive. They're asking the right questions, and because they have that responsibility. And I suppose
that's brilliant to hear. I know, that's great. And why did the gallery, so you're from the Scottish Gallery, Why did they look at employee ownership? Because it's an odd model for a gallery, surely.
I'm not sure what other galleries to compare it to in terms of an ownership model. I think they're generally privately owned. I work with the Scottish Gallery as one of a number of businesses as a freelance FD, and they have, well, I think there was a variety of reasons, but largely quite a proportion of the shares were held by senior management. One of the most long-standing and senior directors wished to go into partial retirement, although he doesn't seem to have retired all that much. Bill, you maybe find yourself still grabbing the tools and getting involved from time to time. But and we were looking for, he was looking for a tax-efficient exit, and obviously the tax rules around EOT do accommodate that. We considered trade sale and whether we would look in the market for a buyer. We would be quite a trophy asset for someone to come in and run. But really, we felt ideologically that wasn't for us. We wanted to retain the identity of a 175-year history of one of Scotland's premier commercial art galleries. So that's why when our chairman, Will Whitehorn, suggested employee ownership, that we looked into it. I would say we kind of mulled over it for several months before we really pressed go on it. But at that point, we spoke to Carole and initiated the process. I think it took us about 7 months.
Yeah. Sheila, what was your motive?
We're I guess looking towards retirement. A number of years away yet, but we have run this business for 20 years now, and a few years back we started thinking about what was the long-term exit strategy. We had explored the option of employee buyout or management buyout type of situation, because I guess ultimately I've seen too many businesses where they've been sold, built up, successful local businesses being built up and sold on to usually multinationals or become subsidiaries of an external company somewhere else, who's over a relatively short period of time of assets just been shut. Business taking the order book, and I guess the probably most attractive thing I think we've got is our relationship with our clients, and what we're providing here. We've obviously got a skill set and a team who are delivering and good service to our clients, but other companies who are relatively easily, I guess, if they wanted to. So selling and seeing what we've built dismantled by someone else didn't sound like a very attractive option. Having put 20 years of our life into getting it to where it is. So what we were looking for was something to secure the future. When we'd looked at it previously, the company was booming, and we grew very rapidly up. A lot of our customers are oil industry up until 2015, and at that time, the individuals that potentially could have looked at for a share buyout didn't want to put their hands in their pockets or take on the debt that they would have needed to buy it out. So we got to a seminar on employee ownership and felt like that was the right way forward for us to create the trust and get an exit strategy that allowed transition over a number of years, allowed us to move out and to leave it with the employees without somebody having them having to take on the risk of a big debt.
Okay. No, thank you for that. Let me just turn to some of the questions that have been asked in the Q&A. Someone's asked what makes it expensive. Maybe we should ask some of the advisors what makes it expensive. actually, I think you have to look at this in the context of all these kind of transactions. Whether you go for a management buyout or whether you go for a trade sale, it is an expensive process to dispose of a business. So I don't know, James, if that answers your question, but I would say because this tends to be a collaborative transaction, and you're not got adverted as, you know, what Bill was describing with the buyer wanting to get the lowest price possible and the seller wanting to look after the business, then you don't have that adversity, so it tends more collaborative. Therefore, I'd say it's not as expensive as other ways, but it's an expensive thing to do. Carole has asked, if your business is regulated by the Financial Conduct Authority, I know you can't move to sell a business till you have the permission to do so. Any advice? There's actually quite a few financial services businesses going through this process at the moment. There's one that I can't talk about, it's just about to complete on in December. Another one that's underway. And I know there's quite a movement in down over in England for companies who are financial companies looking to make the move to employee ownership. FCA are actually, it's a tortuous process, but as long as it's been done for the right reasons, they don't have an issue with it. So that shouldn't be a showstopper. Another question, as a micro company with plans for growth, but currently one employee owner, is there a precedent for becoming employee owned as a foundational structure? Can it be straightforward? Is there a preferred model? Actually, James, that's quite a complicated question, so I'm happy to answer that probably offline. There have been a few companies that have started as employee owned, but it's in structure, they tend to go down a different route. And I think with another question, what more can the advisory community do to further promote succession option to more businesses? Let's throw that to the panel, actually. Do you think that advisors should be doing more to promote this?
I think it's certainly a route which is, from our experience, Carole, it's a soft exit for the directors. But I also think the advisors, I think everyone I've spoken to is, you know, people are always asking me, because we've, and immediately after going to becoming a trust, we redid all our letterheads and all our media stuff with Crosser Associates, and we had employee ownership company put around the logo. And that's raised a huge amount. That's why we get so many. What do you do? What happens? I think if the advisors understand it, they will see that it's a good exit strategy for the directors, but it's also good for the company. Our company, as you know, Carole, we've bucked the trend in the last 9 months, and that we've taken on 4 staff, which it seems ridiculous. I mean, it seems surreal. In fact, to me, that would never have happened if if John and I were still directors. We just wouldn't have had the confidence to do it. But the reason the staff are continuing to expand the business is they see that the quicker they produce the profits to pay us off, the quicker they become the owners. They get the full benefits of being owners, and that's the big carrot at the end of the stick. But as I say, touch wood today, it's been. I mean, if it had happened in August this year, we would be in dire straits. Obviously, it's not. And sorry, man, press phone off. It's not happening. You know, we've managed to get a few under the table before the COVID issues, and as I say, we've been lucky. As I said earlier on, the staff they've really embraced it and got on with it. And talking about exit plans, I intend to be doing it 3 days a week come January, February, March next year. And the only reason I'm full time is because I think there is a transition period, Carole, where we need the directors still need to be in place. Maybe not pulling the strings, but they need to be there for advice, and they need to be there to pass on the clients to the trust, if you like. You know, it's the same company, nothing changes. It's, you know, the clients. There's no issues apart from the logo changes and all the letterheads changed to say employee ownership trust on them. And I think a lot of people have engaged with us on the basis that what we're doing, and they see that it's a great way forward, because it means that the staff they're in charge of their own destiny. Basically, and to a degree they're in charge of our destiny as well, because they need to make the profits for us to get the money out. So it's a double-edged sword.
That's a good point. Ennis, did you want to come in here?
Yeah, well, these are it's very interesting actually listening to your points, Bill, because they bear out what I'm seeing with the management team and the staff at the Scottish Gallery. But just coming back to expense, Carole, can I ask you, or perhaps it's for Angela, are Scottish Enterprise still offering a contribution towards fees?
Basically, at the moment, what we're offering is a ownership succession review and an employee ownership feasibility study. I think in the past we had offered some funding towards implementation projects, but again, like many other kind of public sector bodies, that funding is on hold at the moment. But certainly, what we're still offering is the ownership succession review and the feasibility study, so that the upfront stuff to make the decision.
Well, that's a help anyway. I thought, referring back to your comments, Carole, I thought, in terms of a fairly major change to the whole corporate setup of the business, the fees were not ridiculous. And we probably paid a bit more to our lawyer than we might have otherwise, because we had about 30 shareholders, and that inevitably meant that he had to do quite a lot more work. But that wasn't overpriced either. So I think we were pretty satisfied. Certainly getting the tax clearance and things like that was not expensive. So I think all in, yes, it's a spend compared to doing nothing, but it's certainly pretty inexpensive in terms of a corporate finance transaction.
And Sheila, your transaction was done during lockdown, wasn't it? You completed in the 1st of July, the middle of lockdown. How was that?
I think obviously we've been thinking about it, and then when we started the process at the beginning of the year, the 1st of July was our 20 years. But that was a good day to make it go into employers. Of course, we hit COVID and we were like, oh my goodness, what we're going to do. But then obviously taking advice of everybody, we thought we just went ahead. So it's slightly, we had ideas of a party on the day and all the rest of it, and we had to kind of put that on hold. But I think it was good in the midst of lockdown, for once we were furloughed and things, that was saying that we still believed in the company. Yeah. The fact that we need to do that, I think if we put it on hold, that would have maybe really made folks feel nervous. But yeah, I think there was a real excitement amongst our team anyway about getting into employee ownership. And I think it gave an up in the midst of what was quite a hard time. Do you know what I mean? Of us doing that. So I'm glad we went ahead with that. Yeah. Brilliant.
Okay, good. A question here now. What's the benefit of selling to an employee ownership trust rather than to an established local charity looking for a social enterprise arm? I would say, Carole, the answer to that is really horses for courses. Sometimes a social enterprise or a charity is exactly the right model. I do know there's a few companies that looked at going for a charity and they decided that employee ownership was going to meet their aims a wee bit more closely. So I don't think there's a generic answer for that. And a question actually, what are the top level terms for a bank such as Barclays providing liquidity for the trust? I'm not sure if we've got any bankers want to answer that, or I could come back to you separately on that question. We've only got 2 more minutes. Could I ask the panel, is there anything you would have done differently? Can you give me 1 or 2 sentences, anything you would do differently, or you would advise someone going down this route?
No, I have to say, Carole, I think it's been pretty seamless. We've had our obstacles, especially with the banking aspects, as you're aware. But we got over them, and I think once Barclays, I think we were sort of the embryonic company they were going to use to go down this route, because they're down south, the head office didn't really understand it, did they? I mean, we had many conversations about it. So the only thing I would say is that if there's a bank that's willing to do it, and as I say, Barclays came through. Disappointingly, the Royal Bank of Scotland, who we banked with for 34 years, weren't interested in it, which unfortunate, because we had a really good relationship with them. But now we're with Barclays because they took the risk, or they understand the concept. I think that's basically what it is.
Okay, thanks, Bill. Innes?
Well, we successfully funded with Bank of Scotland, although there was a property element in the security. But that was maybe where we differed. Do you know, Carole, I sat and thought about this. I can't really think of anything we would have done differently. The process took time, and we had to work steadily through, and we had to ensure that we got buy-in from staff and from, our artist community, etc. But I don't think there's anything we would have done differently, and I haven't found anything in the year plus since we did it that's come out through trustee meetings or whatever that made me think, right, okay. So no, I'd happily sit and talk to people all day about the process, and if anybody wants to get in touch and talk about it, I'll happily tell them about it. But no, nothing I would change.
That's very generous of you. I'm happy to put people in touch with this, and you can take them up on that. What about finesse? Anything you would advise people that you might say do differently?
No, I think so. We got very good consultancy support from yourselves to point us in the right direction, keep us on track. Anything so far so good. We haven't run into anything that I would have said, oh dear, I wish we hadn't done that, or I wish we'd done it differently. So.
Brilliant. Okay, thank you. Angela, can I hand back to you?
Yeah, sure. I believe we've got a final poll, Carole.
Yes, we do.
Again, everybody, we'll just finish up in the next minute or so.
And it's probably worth pointing out that this is mainly for advisors, but everybody's welcome to.
Panelists are excluded from the vote, I notice.
Are they? Sorry. That's Zoom rules, not my rules.
But we're all sitting smiling, so I guess that's a vote that fits so.
Good news.
Well, yeah. One person unlikely to recommend, though. Okay, end it there.
Yeah.
We still have lack of awareness. Is
that our final question, Carole?
Yep, that's the final question.
Okay, well again, just before we close, I'd just like to thank Carole for her presentation today, and the panelists for taking time out to share their experience, and to everybody for attending this session. I hope you found it useful. Finally, a short evaluation should appear at the end of the webinar. We're grateful if you could complete this, as this is the last webinar in the current series. However, we are running a final event in February that you or your clients might be interested in attending. It's called Selling Your Business, Find Out Why Pacific Building Became Employee-Owned, and it's taking place on Tuesday, the 16th of February at 10 AM. Just to let you know that a summary of the session and a recording are available, and the evaluation will be resent just in case you don't receive it directly. So again, many thanks for participating today, and have a good day, everyone.
And thank you very much to the panel. Thanks for participating. That really helped.
No problem. No problem.
You're welcome.
Thank you.
Welcome. Excellent. Thanks very much, everybody. Bye-bye.
Goodbye.
Bye.
Bye.